Hit start.
Good afternoon, investors. Welcome back to Bull Sessions. My name is Mark Robertson. I am joined here by Ken Kavula, and Kevin Gologly has snuck in the back room. Good afternoon, gentlemen.
Good afternoon, Mark. Glad to be with you.
Good afternoon.
Always good to hear from Baltimore. And again, Kevin has been a strong contributor to a number of recent roundtable sessions, and we greatly appreciate that, Kevin. And
Glad to help out.
If it were your birthday, I would wish you happy birthday.
I'm coming to you from the great state of Maine. We're about as far east as you can get, where the birds start singing at 3:45 in the morning and the sun's already up.
Whoa. Well, they should be singing happy birthday. It's sort of a happy birthday. We've been doing this now for 3 years, Ken. So these Tuesday afternoon sessions, they are pretty popular, and we get some outstanding feedback. So thanks to all the attendees, and please let us know what you want to hear about. We're actually going to tackle a subject here today that's probably not of much interest to some investors, including probably Ken and myself. I have a limited interest in options, long-term options, but it's worth. Again, Ken, I always go back to the rule of our investment club was we attempted to collectively understand something, at least enough to be dangerous, and then decide whether or not we would use it. And I think that's good advice for this type of stuff. So
I think it's a great rule for investors, period, Mark, if you come up with something you don't know, at least take a half an hour to try to figure it out and then decide with some basis why you don't want to do it, whatever it happens to be. I know that's true with a lot of strategies for selling stock that we've listened to over the years. Most of my clubs have rejected most of those strategies, even though sometimes on first blush they've seemed just the thing you need for a certain circumstance.
Yeah, and I agree. I mean, I think back to our investment club in Chicago back in the mid-1990s, where we had a rule in the early days to sell if one of our positions gained 30%, and sell, ask questions later. And we gained 30% in Dell Computer, and then never looked back. Well, actually, we did look back. It was painful to watch it gain like 40,000% after we sold it. Didn't buy it.
Had that same experience, Mark, with the second stock we ever bought, which was Electronic Arts back in 1980 something, the late 80s. And we bought it. It was a brand new company, and we tripled our money in a very short amount of time and got so excited we sold it, and then never got the opportunity to get back into it, as we learned that you should buy stocks at a decent price. You shouldn't be chasing the price of a stock. So we watched it become a 10 bagger and a 15 bagger and a 20 bagger before it finally became a kind of a well-behaved stock.
Yeah, this investing thing can be a challenge. All right, so one of the things we are going to cover here today, about 15 months ago, I laid out this theory or a conviction or a feeling about the QQQs, the NASDAQ 100. And we're actually going to touch base on that and how I used options, again, in an effort to learn and reinforce some stuff. And then over the next, we won't get to it today, but we'll extrapolate that in the same way with the Russell 2000. Sean Mace actually coined the phrase rascals. We didn't want to use rabbits because we tend to look at the small company red rabbits around Halloween. If we start pulling into the Russell 2000, looking for opportunity in the medium and smaller sized companies, again, it's a wide spectrum. We needed something other than rabbits. So Sean has dubbed the Russell 2000 the rascals, hence the little rascals on the cover screen.
And I will tell you, Mark, if you can name the two kids that are on the screen, you're as old as I am. Okay?
I can't. I can name Ken and Mark and the monkey.
Well, I can name the other two. Let's see if the audience can. All right.
Oh, okay, we're into audience quiz time. I did think it was appropriate that the monkey snuck on the slide also, Ken.
All right.
I just remember, was there a Spanky?
There was a Spanky. He was in charge of the group. I think you have my face over Spanky. I'm not positive, but I think you do. Yeah.
That's probably the only name I remember. But
Well,
And
we're getting
Mark,
the
you may
names
be
right
over
from the
Dartmouth.
younger guy here. Matt Spielman got the names right from a younger guy. So interesting. All right. We'll give you a little bit of time to research it on the internet, folks, before we tell you who they are. Okay. Go on, Mark.
all right, let's go ahead and roll, and then we can check into the names. This is simply our frequent reminder that Portillo's is not sponsoring this session, but they should be. All right, here's the disclaimer. Standard disclaimer, you guys all know the drill. This is all about education, demonstration, and illustration of stuff. No investment recommendation whatsoever is intended. We are simply attempting to interpret and share the principles, methods, techniques, and philosophies of the modern investment club movement. It's been good to so many of us for the better part of 8 decades in terms of total experience of the organizations. And again, we will be sharing opinions about that stuff. Please do your own homework before making any decision. Our roundtable is a couple of weeks out, but if you'd like to be reminded about that event, or if you'd like to have a friend or family member that you would like to give a nudge to, send an email to nkavula1@comcast.net, and we'll be happy to put you on the reminder for those monthly webcasts. If you have any other questions, our 2 email addresses are there at the bottom. We do post a copy of the PDF of all these slides on the Manifest Investing Forum. Particularly important today because I did attach the old Chicago options course that we did, or session that we did a little while back. So do we have names on the little rascals for now?
I'll tell you, Mark. Usually our audience comes up. We get half the audience telling me who they are, but nobody wants to join the septuagenarian group. I know Matt's not that old, and he got it right. And we also have Aramita, one of the 2 Watson, and they both got it right. It's buckwheat and alfalfa.
Oh, I knew alfalfa.
Yeah, it's Armida Watson. We're actually in the Montgomery County Model Investment Club together, and we actually had our summer social this weekend where she combined our club and her second club. So since we're both online clubs, we decided we'd start meeting socially so that we can have some kind of connection. So we had a great time at Armida and her husband Rudy's house. Great
Fantastic.
job.
That's a great thing to do, I'll tell you. Wow.
Well, Matt and Armida both know their little rascals. Sometimes, Mark, you'll see it on TV as Spanky and our gang.
Yeah, that's probably how I knew Spanky.
Yep.
All right, and here's just a quick tip of the construction cap to the fact that we've been doing this for a few years now, and it's kind of a birthday. We started in July a few years ago, and the whole intent is to grab onto something and kick it around, share screening results, share techniques and features at Manifest Investing or any other third-party source which we find interest in. And again, it is all about the sharing of ideas and the exploration together. So happy birthday to all. And thank you, Ken. And Kevin.
Happy birthday to us. Yes.
Good stuff.
And the boy is doing all kinds of stuff there. That's good.
Yeah, he gets around all year long.
Right.
All right, we tend to present this one every week, at least we have for a while. You will notice that in the most recent update, the light-colored green bar, that is basically the stock market as measured by the Value Line Arithmetic Average. It has sagged back a little bit. We had a few tough days at the end of last week. And it's kind of interesting that the return forecast, the Value Line Median Appreciation Projection, that's basically the average of all the companies in the standard edition, that also has declined a little bit. So what you're seeing a little bit, in my opinion, and based on my observations, you're seeing a little bit of a relaxation of expectations in some of the companies out there. Nothing major, just a little bit of maybe they were a little bit too frothy earlier in the year. And again, we just love the Ben Carlson quote at the bottom because it covers so many things. Your thoughts, sir?
Well, my thoughts are we're in a pretty average market. We have been for the last 2 or 3 months, and no matter what they say on TV, I just don't think we're that far from an average return going forward. It's that's the way it looks to me, and that's the way I'll call it until I see it differently.
Yeah, that 11.6% return does match the long-term average, and the fact that we are actually within striking distance of the trend line basically underscores that that thought. All right, here's our quarterly update of the Value Line forecast versus what actually happened. So, Ken, how does this strike you in general? How do you see this?
Mark, I think that there's an amazing fit. I mean, for as disparate as the data happens to be, I mean, it's coming from two very different sources. I think that the Value Line does a reasonable job of predicting the future. It's by no means perfect. I mean, Value Line wasn't able to predict the pandemic any better than anybody else was. You can see the distance between the red lines and the actual performance there when it goes beneath in 2019. That's well, I'm talking about where the green one goes beneath zero in 2019 there, Mark, at the low of the pandemic. But all in all, and I don't think Value Line was ready to predict the strong spring back that happened after the pandemic. But all in all, I think it's a pretty decent fit. How about you?
Well, the story remains the same for me. No, that'll launch Kevin into some Led Zeppelin. The song remains the same. What I see when I look at this is I think, acutely aware that what Value Line does is dramatically similar to what the National Association of Investors in Better Investing and Manifest Investing do. Value Line tends to rely almost completely on price to cash flow for their version of a stock selection guide. We've actually put up slides which show what looks like a stock selection guide visual analysis that used to be on the Value Line pages. So they are cousins separated at birth. And what this graph always says to me is that what we do works. Finding the notion that you can find better companies at better prices is something which is feasible and something that can be experienced. So that's what it says to me.
Mark, I'll make the point also that I do think that when you use an earnings denominator, that's a little bit more accessible to the average person on the street than when you use the idea of cash flow. I think cash flow is a undetermined definition for a lot of average non-investors. And to talk about cash flow, I think you get a lot of glazed eyeballs when you're trying to explain what cash flow really is. Earnings, I think, are understandable by almost anybody, and I think maybe that's why Nicholson went to earnings rather than piggyback on what Value Line was already doing.
Could be. All right.
Well, one thing to keep in mind, Ken, with cash flow is that the SEC didn't require cash flow to be put on the reports until the mid 80s. So even back in the 50s and 40s, you didn't have access to that information. That was considered proprietary.
That's a great point as well, and a great point. Yeah.
Okay.
But I think they started doing Value Line started doing their cash flow line probably somewhere in the 60s, maybe even the late 50s. One of their guys who just passed away a couple of years ago was the one who sort of set that up. So they may have had their own calculation that they could come up with.
Yeah, I'm sure it dates at least as far back as 1960 because that's in Bernard's book, so which was published in 1958.
Mark, do either you or Kevin know what the original Value Line was then? Because that was an actual physical graph at one point, wasn't it? That the name of the journal came from? Yeah.
Yeah, it's always been that line on the graph. And that sounds like I've actually got the book in my hands right now, but I will go back and see if there's something I can capture for next week to share. It's a good point.
Yeah, are we saying that the definition of what the line was changed in the 50s or 60s? I don't know if we're saying that or not.
I don't know. I don't think so.
Okay.
I don't know the answer. All right, let's keep rolling. All right, this was kind of fun, Ken. We attempted to take the Barron's top 10 selections for 2023, which, by the way, they're not doing bad. That's actually pretty good for the kind of eclectic mix that they've got here. But we also attempted to identify which ones we thought would do the worst, and that's what's actually listed here. We thought Delta would do the worst. We thought Alphabet Google would do the best. So that's the way to read this chart. What do you see?
Well, what I see is that those of us that thought Alphabet and Amazon were going to do pretty well were thinking correctly, but boy, were we out to lunch on thinking Toll Brothers and Delta had their best days in the sun and weren't going to do well at all. I mean, I just could never have imagined, especially I could never have imagined Delta doing as well as it's done this year.
Yeah, and I think Bank of America got caught up in that whole mess. I think they'll be just fine. I do think it's amazing that Toll Brothers has managed this in the middle of all the nasty stuff written in the newsprint about that particular industry.
I do think we kept track individually. Didn't anybody pick Alcoa as doing the worst?
Not first worst anyhow. Some people had it as their second or third choice.
Okay, so
those are first place votes at the bottom.
Worst, right?
Yep.
Yeah. So,
one thing on Delta to keep in mind is that it was the undervalued feature in July of last year. And, you know, our webinar that we do in the DC regional and Maryland chapter, so we feature it and we track it on the Manifest dashboard. And you're right, Ken, it just jumped. Another one that looked really poor in November of last year was Boeing. And that too has also jumped quite well. But if you were to look at either Delta or Boeing using the visual analysis of the SSG, you would have ran for the hills.
So is this an advertisement for your webinars, Kevin? Is that what this is?
It's welcome.
I'm just pointing out that it's Cheryl Patterson, our chapter president, did that presentation. She did a great job.
So since none of us are making any money on any of these things, go to watch Kevin's stuff as well. It's good stuff. I've been a couple times and I can tell you it's very interesting stuff. What day are they again, Kevin?
It's the first Monday of the month, unless it's a holiday, 7 o'clock Eastern time. So we actually had it last night. And on YouTube, just like we have here, we're putting them up, and it's actually uploading as we're talking right now.
Okay, I'll check that out because you caught me on the tennis court last night.
I hope Titan beat your ass.
I hope not, because that would be an interesting explanation. Okay, so here's another one that, again, one of Ken's longtime favorite themes is if you're in this for the long haul, you really don't have to worry about all this daily and quarterly noise. So, Ken?
Well, you know, the percentages at the top of those bars speak volumes to me. And if you give yourself a 20-year time horizon, I think that's what that one bar with the 100% on top of it is signifying. It's even better if you give yourself a 30-year time horizon, but let's just stick with a 20-year time horizon. Let's say that you've decided to become a serious investor when you're, let's just use the word 45, the number 45. That gets you out of your job when you're 65. I think you have a really great chance of, with the systems that we've put in place and with the probabilities that we have going for us, I think you have a really great chance that you're not going to lose money in that 20-year period. Nothing guarantees you that you're going to make huge amounts of money, but a lot of times we would like to just at least leave our job with our nest egg intact with whatever we've contributed to it. As a teacher, I was contributing to a 403B, and the month that I left the job, we took our 403B money and put it into IRAs that we could manage ourselves, and the combined total return over that 32-year period for the 403Bs was only about 4%. In other words, it had lost money to inflation. Now, I'm happy to say that I've been able to change that quite a bit with managing it in the 22 years that I've been retired now. So I got all my 403B money and then some still sitting in the bank, Mark. So
Good
that's
stuff.
with my broker. So that's a good thing.
All right, just a couple of observations. You guys all know this. I don't like to look at anything before 1941, so it doesn't change this graphic at all if you go back from 1941 through the current. The other thing that I hadn't noticed until I was just sitting here actually reading the slide. One day, that's a coin toss. Is that not a coin toss? That's a
Sure
coin
it is.
toss, pretty
Yeah.
much. So one day is a coin toss as to whether or not you're right or wrong. So
Well, and a slight to the positive there, which just tells us that the market usually has a better chance, a slightly better chance of going up than it does anything else. You know,
Yep.
we like the long-term trend of going up, and the coin toss becomes less of a coin toss as you move to 20 and 30 years. Becomes a fixed coin at that point. You know, two heads.
So I'm 2% optimistic. Great. All right. Speaking of optimists, here's our update on the Groundhog Challenge. We have an absolute slugfest going on at the top. The top 4 people are basically changing position by the minute now. And Matt continues to hold on to a nail-biting lead at 20.5%. Ginger has been ahead of him last couple of days. The Lone Star group out of Dallas is right there in the middle of the mix. And I do find it kind of interesting that the Launchpad selections from our screening technique are there. Maybe we'll do a little bit of a feature on that one also. If not next week, the week after that. Just as a reminder what that is all about. By the way, the Fave 5 screening criteria known as the Launchpad was inspired by the St. Louis Broad Assets Investment Club. So St. Louis is represented. And Ken, I'm still hanging in here. I see you're still hanging in here.
Yeah, I like to look at the top 25,000 mark, and to me, we got a race going on between Matt Spielman all the way down to Ann Renly. I don't think it's a whole lot to ask of these $1 million portfolios, $1 million plus portfolios, to move $25,000 in a really good day in the market. So I think you got 7 people, I think, that are sitting around, and if I were drawing lines in order to start grading based on position, I probably would put Jerry Warner in that top group rather than the group beneath it as well.
Mm-hmm. Pretty decent looking leaderboard. A lot of familiar ones and a lot of new people up at the top. So we'll check back in later. And for the first time in a long time, we actually have pretty decent good news on the best small company portfolio. Before the July 4th holiday, we were tracking at a relative return of -8 or -9, and that has improved a fair amount. Thank you to any of you who are going out and dining at Portillo's. We need to keep moving that up the list, and we just continue to be hopeful. This is a much better difference between the two than it has been. And as Ken has pointed out, it's always nice to stay ahead of that Russell 2000 also.
Yeah, I haven't said this, Mark, in 5 or 6 months because it hasn't been true. But when we put our list together, I told you I was going to buy 3 of the stocks. I really liked 3 of them. And for the first time now in a long time, all 3 are green on the relative return column.
There you go.
I will tell you that I own Technoglass, Fox Factory, and InMode. So
very good. And Malibu Boats was our featured stock for this month. So Malibu Boats actually has a pretty good long-term outlook. So might be worth digging in and taking a closer look. With MP Materials, we can continue to be mystified by the production expectations as they open up more production facility, and wonder if that still isn't misunderstood, or we could be wrong, Ken.
I will tell you, Mark, that if you read, the last time I did deep reading on MP was whenever we put this list out was maybe 7, 8, 9 months ago. If you read MP Materials, it sounds like They're doing a lot more even with their phase 2 and phase 3.
Mm-hmm.
And I still think that the whole thesis is in place. Maybe it's not moving quite as quickly as we thought it was going to move, but I don't think that MP Materials is a broken company.
No, and we still have pretty nice indications here when you take a look at the projected return. It's still a fairly high quality situation, so
Yeah.
we'll continue to ride that storm out. All right, just a quick, I think this will become a regular feature, Too Simple, because I like the summary so much. Performance perspectives, much like they do in Better Investing Magazine, only this is slightly different. I have come to refer to this group down here as Indexville. If you want to invest down there, you are looking at returns down around 10% for all of them. Again, we're looking back at 30 years now. 30 years of actually talking about this stuff. And then we continue to be bolstered by the fact that all of these companies up at the top here show up on our most widely followed list of companies, meaning that many of them are magnificent portions and contributors to all of our portfolios. So the round table is hanging in there right around 5%, continue to hope for the best. But the thing we are going to talk about, again, continuing next week, is the fact that these two entries down here at the very bottom have consistently been at the top of this group. It's always been up here, closer to and above the value line arithmetic average. Again, the value line arithmetic average we consider to be an all of the above index. So that is kind of the way we measure the stock market. And the mid cap and small cap have generally been above that or near it. And it's just singing out, as it has for the last several months, is there potential outsized opportunity here? So that's what we will be attempting to take a little bit closer look at. Anything else jump off the page for you, Ken?
I'm just going to say again, Mark, and I won't say it as long as I've been saying it the last 3 or 4 weeks. Make sure you understand what the last 3 columns mean, folks. Do not focus on the last column as what you're making. If you're looking for total return annualized, that's the 3rd column in, the first green column, not the 3rd green column.
Yeah, this is the actual money column here as to what you're actually returning. And again, anybody asks what's the long-term return on the stock market, notice the number of tens in that middle column. Again, over decades. All right. So with that, let's go ahead and talk about a little bit of an educational subject for today. Again, back in mid-May of last year, I talked about, and I am not kidding, this all was actually born on the back of a margarita napkin. So you can either hang up now or stick around to see how crazy it might get. But what we literally said, what would we be looking for, for us, a situation where we might attempt to demonstrate some of these long-term options. And actually jotted down, we want an equity or a fund or an index with an above average return forecast. We would love to see it in an oversold condition where the relative strength index is down below 30. Now for a fund, as opposed to a stock, that could actually be 40, just because they're not quite as volatile because they're all kind of smoothed out. In fact, for stocks, we like to see them below 20. So again, some measure of being oversold. And then we also wanted to see activity or interest as demonstrated by volume at relatively high levels. And we had all 3 of these conditions with what is referred to as the tequila trifecta. TQQQ is a triple leveraged NASDAQ 100 fund. So that alone is craziness. But it's going to move 3 times as much in any given day as the NASDAQ 100 index value. So it's not for the faint of heart. And again, as a reminder, especially if you're going to throw the leveraged funds in there, this is clearly speculation. Did I say that enough time, Ken? Do I need to put a star here too?
Coming through it loud and clear. Mark, I want to give you a chance to correct yourself. On point 2, you said 40 originally, then you said 20. I think you meant 20 the whole time, right?
No, 40 for funds. Because
40
for
funds.
Yeah,
Okay.
fund, FUND.
Got it.
That's what the QQQ would be a fund. So they don't bounce around as much as individual stocks. So it's actually kind of rare, relatively rare, for a fund to be down in the low 20s or teens. Okay. All right. So with that in mind, try this for the an attempt to prevent any coulda, shoulda, told you so's or whatever. I'm a rookie when it comes to this stuff. I think many of us are. There are some experienced options people in the group. I get that. Many long-term investors might consider this madness. That's fine. What we're going to talk about here is a small sample size. Keep in mind that for this one specifically, it's actually like pouring gasoline on a raging fire. This is a very leveraged approach. There were actually days last year when it went up or down as much as 30 or 40%. So that's clearly not for sleep at night investing very often. And then one of the strongest bull markets for QQQ. So yeah, the convictions and the expectations were right. From 12 to 15 months ago, and that did help quite a bit, the results we're about to talk about. And then as we asked many of you, do you want to talk about this subject or not, we got many flavors of that same response down at the bottom. I think, Ken, you probably share that last disclaimer for sure, right?
Absolutely. I'm just not sure I want to spend every moment of every day dealing with my investment portfolio. So I tend to stay away from options, and I'll do all the disclaimers on the entire list. I don't know that much about them. I don't understand them sometimes, and I'll admit that. And I think I'm smart enough to understand them if I choose to. So I think I'm making a conscious choice not to a lot of times.
Yeah, and I would share that conviction, especially with what might be called regular options. Stuff that expires pretty quickly, and we'll talk about that. I don't think I have time or the inclination for that either. And I would share that Warren Buffett has come out with respect to options and says that he thinks they should be illegal. Peter Lynch dedicated an entire chapter in One Up on Wall Street to say you don't need these. And he basically professed that he didn't have the time to actually even understand them or try to figure them out. So you're in good company if you decide it's not for you. But by the same token, again, much like we said at the beginning of this session, sometimes it doesn't hurt to at least attempt to understand them to a level where you can decide if they're for you or not. And that can cover a whole number of topics, including things like shorting stocks, all that kind of stuff. Understand it doesn't mean you have to do it. So understanding it doesn't mean anything. Now, Ken, you would like to understand how do we decide they're working, right?
The only other point that I would make is, Mark, is that I don't think that investing is a subject that you learn in a linear fashion. And I don't buy the idea that there are advanced topics and there are regular topics and there are beginner topics. I think there are just topics. And I think that it's like the fingers on a hand after you get your most basics down in your mind, and you make choices as to what you want to deal with and how you want to invest. I go back to that chart we had up a little bit before that says that 20 years, I stand a pretty decent chance of not losing my capital. And if I stand a pretty decent chance in 20 years and I've put my 20 years plus in, then I don't know whether I'm not going to go out and go sailing or play golf, but I certainly am going to spend time playing with the grandkids.
And you actually mentioned fingers, and after the July 4th, everybody has to make sure they've got all their fingers. I am one of those people that I have no interest in lighting off M80s in my front street because I've actually seen somebody lose at least part of a finger before, and that's not fun either. All right, so here's a look at, we've published these a few times on the forum. What I don't want to pretend here is that I have any special sauce or recipe. This is just how, in this case, 44 separate contracts ended up over the course of the last year. you can see that most of them are invested in that triple Q, triple leveraged fund, exchange traded fund. We did sneak in a few Ardelixes just to annoy Ken. So there's a few Ardelixes in there. They actually worked out. I just wanted to experiment a tiny bit with investing in a options based on a stock instead of a fund. And those actually worked out pretty well also, and with similar type convictions. So you can see that we did kind of stick to the low RSI in and then a relatively high RSI out. Once they became oversold, we tended to sell them. And we are, at this point, 44 for 44. In fact, every single one beat the market except for just one position up here. So it is a bit compelling. The 39%, if it were sustainable at all, would be something that might actually be worth the time. And that's what we're kind of asking here. Is it worth the time? This particular brand or flavor of options is a little bit more like a stock. That's why I referred to it as a middle ground, and we'll explain that. But it's not that day-to-day, minute-by-minute thing with that you see with some options. And the longer-term option definitely is something to think about. Just as a bit of housekeeping, if you take a look at the ticker symbol that is over here, you can actually break that down and read it. The first part of it will be the actual thing that it's invested in, the underlying, and that's TQQQ in this case. The next section here is the expiration date. So you can see that all of these were all the way out in January of 24, even while we were doing this in 22. So again, we were staying a year and a half to 2 years out. The C stands for calls. You have calls versus puts. And then the number at the very end is the expiration or strike price for the option itself. And you can see we were playing around. I actually chose that based on my instinct or expectation that it was possible for the QQQ to get back to $40 a share after it had dropped down in early 2022. So that's how you actually read those and see that. Any questions on this page, Ken?
So Mark, when you bought a contract for $1.80, which that's what I think the chart is showing me right there.
Yes.
You were betting what? What were you betting that was going to happen?
Again, you're just betting that the price will continue to increase up towards that $40 level on the QQQ, TQQQ in this case. So basically, my expectation at that point in time was it was still feasible a little over a year from then to approach that number. So again, we're talking about a relative, not a relative return, but a projected annual return that was still elevated at that point in time.
Okay, let me ask one more question. Why do you use a current price of 340 when you actually sold it on 525? Was that the price you sold it on 525?
Yeah. Any of these that are shaded in, just like we do for our roundtable chart, these are actually closed positions. So every single one of these would be the sell price.
Okay, so
for all of these transactions, and these are all the sell dates.
Okay, so that's an 88.9% of going from $1.80 to 340, right?
That is correct.
Okay, and that's not an annualized number then at the top of that column like we see a lot of times then.
No, because we're dealing with less than 1 year. Anytime
Right.
it manifests investing,
less than a year, right?
Anytime we're
Okay.
less than a year, it's the absolute return. Anytime it's more than 1 year, it is annualized.
Okay, it's making some sense. All right.
You're not going to see very many of these held for more than a year. Not very often, anyhow.
Well, and I'm looking at the average hold, and the average hold looks like it's anywhere less than 4 months. Is that about right?
Yeah, the average holding period was about 139 days.
Okay.
Which is actually long for an option. Those people in the audience that understand options, that's a long time to hold an option. Okay. All right. I thought we would borrow from an old presentation. We learned a lot with the Chicago audience back in March 2011. I think we may have presented pieces of this along the way. Again, I just wanted to give a reminder. I'm just going to take a couple excerpts from this. It was an interesting day spent with Matt Willems. You may remember the day, Ken, in Chicago. There are some things to consider for options. We're going to cover covered calls next week, and that is one of the areas that Matt believes very strongly in. But one of the things I wanted to point out was that Joel Greenblatt, the guy on the far right, actually wrote that book on the left, You Can Be a Stock Market Genius, and he is a pretty staunch advocate of long-term options. And he spends a chapter on it in the book. And as Ken and I noted in the pre-session, that book was part of the foundation of our work on projected return on value, PROVE, at Manifest Investing.
Mark, can I catch up a couple of questions before you move into this next piece here from our audience?
Sure.
Ann would like to know, when you're buying this, does it mean you have to keep it until 2024?
No, you can buy and sell just like a stock. You can buy and sell any one of these for whatever the quote unquote market price is at any point in time.
Okay, and that $1.80 that we circled in that last position right there,
Mm-hmm.
Is that for a single contract or is that for a single share? And the contract is 100 shares.
Yeah, that's a single contract price. That's the way options are quoted. Those are always the contract prices.
So are you spending $180 then for a contract?
Yes.
Okay, and a contract is 100 shares, correct?
Mm-hmm.
Okay, so that is a.
It's actually 100 shares.
Yeah, Anthony, the $1.80 is a single share, and the contract is $180 then.
Yep.
But we're doing everything dividing by 100 there, so there's no arithmetic mistakes.
Mm-hmm. All right, so we will talk a little bit about this. Here's the thing that actually prevents me from doing standard or regular options. I can't stand the notion of the game clock running out. And for any option, basically the value of the option is a combination of this component, which is a declining or a decaying value in combination with some proportion of the stock price or the underlying fund price. And the real heavy action actually starts out towards the last month, maybe month or two. And you can see, like I said, Ken, we were actually holding on to these 139 days. Keep in mind, though, that we are way out here. We're on the left-hand side of this particular characteristic, so that you're actually operating where you don't get much of a decay in the option price because of the time effect. You think of it as a plateau. And this is probably the only way I could ever do this, is to know that that is relatively stable and basically permitting me to sleep at night. Because again, this notion of going to zero is tough to take when that is not your intent. Okay. So again,
we're going to get a couple more questions and a couple comments here, Mark.
Okay.
We're still getting a number of people saying, "What is this an option on? What is the option about?"
Okay.
So when you said that it was $1.80, what were you saying?
What you're actually buying is the privilege or opportunity. It's optional. You don't have to do it. That $1.80 is allowing you to buy shares of TQQ at $40 a share. So let's say it went up to $50 a share tomorrow. You can actually buy those shares for $40, sell them immediately, and pocket the $10 difference. So an option is simply the opportunity. And I'll throw a slide in on this for next week just to clarify.
And Mark, your gain would have been the $10 minus the $1.80, right?
That's correct.
Okay.
So you're actually buying the privilege. Some people like to explain options in terms of thinking like an insurance policy, where premiums, you pay premiums, and you hopefully don't have to cash in your house insurance for a fire or calamitous damage. I mean, that's how you would actually net a return, but the premiums are paid, and they're just paid along the way, and they expire, but they give you the opportunity to recover that damage cost if it ever were to materialize. So you can kind of think of it in parallel. It doesn't work for me, but some people find that is the way to think of this as premiums. If that
Okay,
helps.
so if I could restate that, you're buying the right to buy the share that you're putting the option on, to buy it at a set price in the future.
Correct.
And you're hoping the future price is not only above the price that it's trading for right then, the $40, but you're also hoping it's above the price that it is now when you're buying the option, plus the cost of the option, right? So you're hoping the price goes above 41.80.
That's correct. And in fact, we can use this graphic to illustrate it a little bit more. In this case, this is an option on Abbott Labs, which you see here, the ticker symbol ABT. Okay, this is a $50, as Ken said, right to buy Abbott Labs at $50. And in this case, the stock price is shown by this yellow shaded area down below 50. Now, again, under the assumption that what if it did go up here, you could actually buy it for 50, and that would be your gain for this particular option. So you actually are buying what you are paying for, to answer the question, is the right or opportunity to buy it at 50, no matter what the price is. Now, the problem comes is, what if it never gets to 50? It expires worthless. Down here, you can see the option price. As the date for this actually expires, this blue line will actually end up at 0. That's what this ticking time bomb is all about. So again, this is not an area that I play in. Don't have much interest, don't think I have the time or discipline for, but with long term, you basically are in this situation where you don't have that to worry about quite so much.
Mark, could you put the slide back on with the chart? And I'm going to speak to two people in our audience specifically. You know who you are because you've been typing in the question box. Could you go back one slide, Mark?
To this one?
No, back one more, I'm sorry. No, I want the chart.
This one?
You had this one right here, okay? Notice that this is a $40 option, and you're buying the right to buy that stock at $40. And on the day you bought the option, which was $12.15, you only had to pay $1.80 for the option. Mm-hmm. So you were hoping the stock price, and again, I'm speaking to folks in our audience, you were hoping the stock price was $41.80 or better. Now you didn't sell the stock at this date here in what is that, May. You didn't sell the stock on 5/25. What you did was you sold the right to buy that same stock, and you sold that right, which had increased from $1.80 to $3.40. So if you were buying the option on this date, you would have had to make $43.40 on the stock to break even. So you sold the right to buy it for $3.40, and because you bought that right for $1.80, you made this profit here, or $1.60, or about 90% on your investment. At no time did you buy the TQQQ. At no time were you buying the actual share of that TQQQ. You were buying the right to buy it in the future. I hope that helps some of you.
Yeah, it's difficult.
I'm getting thank yous, so that helped a few people. Great.
Yeah, and you really have to think of these as standalone entities. I mean, I don't have the price movement in the QQQ shown on here. That is shown for Abbott. You can see how the stock price is moving while the option price is moving. Okay.
Mark, here's a good question from our audience. Who sets the original price for the option?
Run that by me again, Ken?
Sets the original price when the option first goes on the selling block. Who sets the price for that option?
Well, I assume it's some form of market making. It's just like anything else. There's it's the market. Now there may be a market maker involved in establishing some kind of level, but um,
Okay. So it would be the same kind of a type of process, we think, as when you set the price for a stock on a given moment when you want to make a sale, and that involves an auction between a buyer and a seller, right?
right. And the factors on the right are what basically determine that. When does it expire? How is the stock, in this case Abbott, behaving? How volatile is that stock in terms of up and down price movement? And interest rates will play a factor also.
Well, and since brokerage firms are intimately involved with this options, they probably are the people setting the option prices at the beginning of the contract.
Yeah, I'd say I don't know exactly who does it, but again, I think it's a normal
Yeah.
market process.
Okay.
Okay. All right, so I thought I would close with a couple of case studies which have always intrigued me, and you've heard us talk about these from time to time. Hugh McManus really is an interesting investor slash speculator. And many of you know Hugh is an actively employed pharmaceutical scientist. So he has direct knowledge of this area. 10 years ago, he did a couple of presentations on the pipeline. And as part of the second presentation, by the way, you can get both of these presentations on our YouTube channel if you go back to 2012 and actually dig them out. They've been very popular over the years in understanding this process. But he has done quite well, and that is really underselling it over the years doing this stuff. So back in 2012, this is something that had been kind of gyrating around for a couple of years. He actually featured what he referred to as the obesity pill drug race. Now, that's not the current one that you've been reading about here for the last year or so. Is that fair, Ken, as far as Lilly and Novo Nordisk?
Absolutely fair. This was the pill that was supposed to solve all the problems, but just traded one set of problems for another.
Right, and then the side effects were horrendous, and
Yep.
the only one that came out with anything which was slightly acceptable was this Arena. And back in this time frame, he was talking about how the entire sector had been absolutely demolished with respect to price, and all of these companies were trading down basically in penny stock land, pretty much by zero or near zero. And he bought options on all three of them at the same time. And his thinking is right here. Somebody's going to win this thing. And when they do, the amount that I get from the winner will more than offset, even if the other two disappear from the planet. That's exactly how he described it. And lo and behold, he bought into Arena at less than $1 a share. We'll talk $1 for now, and ended up selling Arena to Pfizer for $100 a share. So you may have heard him flippantly refer to, boy, it'd be nice to buy a stock for $1 and sell it for $100. He's done this. And again, that's a 40% return over 12 years. And that is fun when it happens. So again, the voice of experience talking, and he does dabble in these type of options every once in a while for these type of companies. Any questions?
And Mark, I'm just going to ask you to put a big red line under annualized return of 42%.
Yep. That is it's a huge number. I'm afraid to ask him how much he invested in it. All right. And then in another situation back in that same time frame, Hugh and I had been having a discussion about Walgreen. If you've been around us for a while now, including the roundtables, you'll know that Walgreen was a popular stock back in the roundtable back in these days, back around 2012. I think it said, yeah, it was selected 7 times back in this time frame, and Hugh actually wanted to pick it for an 8th time. But it was back in the days when CVS was going basically full bore. It was a war between CVS and Walgreens, and there was a whole bunch of stuff going on with the PDA market and PDM market and everything else. And Walgreens was in a bit of a war with Express Scripts. And back in this time frame, the Walgreens had dropped down into the low 20s. And I called him up one day and said, I think they're going to kiss and make up. And that was basically my basis was Walgreens is not going to disappear from the planet. They're going to be okay. We've elected for the roundtable 7 times. I'm actually going to buy some. So I did this. So I bought a couple hundred shares and invested in Walgreens. That's about $5,000. And I was happy. So he calls me back the next day and he says, I'll go you one thing better. They are going to kiss and make up, and I even know when. And I said, well, Hugh, I'll have some of what you're having. And he did his Irish laugh and he said, no, seriously, the lawyers are talking. I don't have any inside knowledge. In fact, Ted Brooks actually asked questions on the forum. You can go to our forum and see this as it played out back then. He didn't have any insider knowledge, just instinct, along with what he thought might happen. He says they're gonna kiss and make up before the Walgreens annual meeting. And I said, well, that's cool. That's actually something you can sink your teeth into. So when you have a conviction on something like that, that makes these long-term options. This was not where he used a long-term option. He used a standard option here. But he basically said, I'm gonna dive into this thing. I'm gonna buy these options for basically a dime. They came out with the announcement shortly thereafter. What he had bought for a dime went up to $2 within days. And so you can do the math. That's 20 times in just a few days. So it was a fascinating thing to watch, and quite an experience to go through. Any questions on this, Ken?
No, we've either lost our entire audience or they're understanding us, Mark, one way or the other.
One way or the other. We'll hope for the latter. All right. And so here's basically the situation. I put this chart up for one reason only. You got to be in these things to benefit from these things happening. Again, my broker phone call saying that he had a can't miss opportunity. The train's leaving the station, and I asked him, well, which boats are pulling in? Let's talk about those. He literally hung up on me. So again, when these things hit, you've got to be invested back here in order to benefit from what happens here. And it actually happened just a few days after that conversation with Hugh, and his option price skyrocketed along with the gain in the stock price. It's just a lot of fun to be on the right side of one of those every once in a while. So here is kind of a summary of the situation. I am actually quite thrilled with making 70% on a stock. These are real numbers. This was a real trade, and my gain was decent over that period of time. I was thrilled with that. But it actually pales in comparison to this over 11 and a half years. I didn't even fill in the numbers. I can't bring myself to do it because he bought those options at 10 cents. Again, that gave him the right and the privilege to buy this company up to 33. Well, it proceeded to go to this is a split adjusted price. It actually went up to 48ish, back in that time frame. And his strike price was 33. So he could buy as many shares as he wanted as part of this contract at $33, even though this thing was actually ultimately up to 48. So I'm sure when this date hit, he probably converted to a number of shares. I'll try to get him to share exactly the specifics of that transaction, but it's a massive gain. And then we'll start with that next week and hopefully wrap up that conversation. But again, just illustrating when you've got a situation with a company you think you can understand in circumstances which you think you can make an educated bet on, it's fascinating to watch. And again, this is not one of the long-term options, but a shorter-term option. Same thing applies with what we're doing with tequila and what we will attempt to do with the Russell 2000 perhaps next week. Any questions, Ken?
No, we're quiet in the questions booth right now. So you've done a wonderful job of hitting this right on 3 o'clock, Mark.
Really? That's accidental.
I know.
All right. So what we will do is we'll finish this conversation. We'll talk about covered calls because they are kind of the opposite. We'll finish the discussion on long-term equity options and move on to the covered calls. And I would just like to point out that we got into the utility autopay demonstration use of JEPI, JEPI. They're using covered calls. That's what they do to basically jack up those dividend returns. So some good, clean fun that we will have going forward. here is where we post them. Again, you can go all the way back and listen to those pipeline discussions and Hugh's calling of the obesity pill race back in 2012, right there on that page. All right, one last image for Buc-ee's, and I mean, I can't believe that they advertise over 1,000 miles away from the next Buc-ee's, but they apparently do.
I'm going to tell you where the next Buc-ee's is being built. Compliments of my wife, Mark. Okay.
Okay.
She got a big news flash on her telephone. It just opened in Pigeon Forge, Tennessee. That's right outside the Great Smoky Mountains National Park.
Fantastic.
And if you've ever been down to the Sevierville/Pigeon Forge area, you know that there's just thousands and thousands and thousands of vehicles that go right by that particular place on the parkway almost daily. So it's quite a place that they put their next one.
All right. And we, of course, are watching them to go public at some point. All right. So with that, again, I attached the entire presentation from Chicago to the back. If you want to take a look, it goes through and explains some of the stuff that we skimmed over a little bit. It's certainly a glancing blow in many cases, but that is there in the notes on the Manifest Forum. So with that, Ken, anything else we need to cover?
No, this was a good one. This was a perspiring one today, Mark. This took a little bit of work. So
you guys are making me work on this one, and
we'll try to wind this up next week and then move into a little bit more recreational topics again.
Okay.
We got to say goodbye to alfalfa and goodbye to buckwheat, and maybe we'll have Spanky. And you got to find a picture of my first crush ever, Mark, and that would be Darla. Okay.
We'll get Darla on the screen for next week's edition.
All right, great.
Thanks, everybody. Take care.
Bye-bye, everybody.